Today we will discuss the topic of market recovery and asset classes. Ronnie, will you please tell our listeners more about asset classes and how they relate to investing?
Yes, Justin, anytime. Saving or investing can create wealth, but at the same time also improve your standard of living. It's quite important, though, to have a look at certain asset classes. And when we look at asset classes, we are really looking at instruments that behave more or less in a similar fashion in certain categories. We're going to look at a few types of asset classes and start off with equities. Equities is pretty much a share that you hold within a company. So you actually become a shareholder or part owner of that private company. So in the case of equities, your return is based on either the profit that the company makes, that we call dividends, or in the case of the share price rising, your capital improves or increases, and that would give you capital gain. Then the next asset class would be bonds. Bonds are pretty much a loan that you give to either a government institution or a corporate institution. If we look at government bonds, a typical government bond would be something like Eskom, which is very topical at the moment, Eskom 168. We know that they always need money. So, yeah, if you're investing in a Eskom 168, there will be a term attached to it, and you will receive interest on that bond. Another example of an institutional bond would be loans, like, for instance, Mercedes. If Mercedes are building a few new cars, then they would make use of that finance, and that would also be an example of bonds. The next one is cash. That's probably the one that's familiar to most people. Cash is simply money that you invest in the bank, a savings account. It could also be term related, so it could be a fixed deposit, like a 32-day notice, or money market. Money market is rated on a daily basis, and then also you get a longer term fixed deposit. So that is pretty much cash. Another asset class that's quite popular at the moment is property. Property is giving you good returns over a longer period of time. Of course, property, you can invest in a specific property on your own or with a group of friends. Make a small property syndication and say 5 or 6 guys are buying a block of flats because you can't afford to take the whole property on your own. But at the moment, quite popular without investing in a specific property is you can invest in a property fund. Then we're looking at something like Growth Point that owns pretty much the majority of the Cape Town waterfront. So Growth Point is a typical listed property fund, or Redefine, which is one of the other bigger property funds. And then, of course, Sesfikile Property Fund is also quite a popular property fund. Justin, just tell us a bit more about how the year's been from an investor's point of view.
Okay, it's been a challenging one, definitely. So far, 2022 has been riddled with market volatility. As an investor yourself, you might have been unhappy with investment results. To put things in perspective, 2022 has been the worst start to equity markets since the 1970s. So this is really some unique times. This is due to a few factors. The war in Ukraine has led to supply shortages, which led to oil and energy prices soaring. When oil and energy prices soar, that means inflation increases. And to try and curb inflation, global central banks have tried to increase interest rates. South Africans has also unfortunately had the experience of load shedding, which impacted our GDP negatively. So there's not really been anywhere to hide geographically or sector-wise. Everything pretty much in the equity market has been down. In the past, when equity markets experienced a downturn, you had the safe haven of bonds. But this is where 2022 has been unique. We've seen a sharp decline in both bonds and equity markets, and this is why investors are not really happy at the moment. Ronnie, will you tell our listeners how they should react during these volatile times?
I think the interesting thing about investment is really that people panic pretty quickly when markets go down. What they tend to forget is that we have been here before and we are probably going to be there again. When we look at people investing in equities, you will see that over a year period, for instance, they would put about 40% in equities. And the longer the term, the more exposure they'll have to equities, because their appetite for risk over a longer period is actually more than over a shorter period. And you'll find that over 10 years plus, most people will have about 90% in equities. Obviously, with equities comes risk, so you need to see what is your appetite for risk, because obviously with the higher the risk, you potentially can get a better return. We have seen cycles of market crashes over time, starting off in 1929 with the Great Depression. Fortunately, none of us were there at that stage. But closer to home is probably the 2001 dot bubble, where it almost felt like closer now, where we see that even the tech stocks are now once again taking a bit of a hammering. So it's quite amazing to see how history actually repeats itself. 2008, we had the financial crisis, and now 2019 with the COVID pandemic. None of us really had certainty of markets opening up or when life was going to return to normal. So it's all about cycles. If you panic and you withdraw, we've seen that the best times in the market is actually directly after the worst times. So if you just stay invested, don't panic, have a look at what your goals are, because goal investing is really what it's about. If you're investing over a short period of time, you're obviously going to be more exposed to cash because you want the flexibility of access, where over a longer period of time, you're going to take a little bit more risk and therefore include a lot more equities.
Yeah, well, I think that's very valuable insights, Ronnie, and I do agree with you. If we just look at history, we can see from previous crashes that the subsequent 3 and 5 year returns has almost been triple-digit returns. So that means it does pay to stay invested. We've learned that it's about, as you say, time in the market and not trying to time the market. Missing only a few of the best days has a massive impact on your investment. And this is because usually, again, as you said, the best days are followed directly after the worst days. So trying to time the market is not really going to be possible. Staying invested, rather, is going to give you the better returns over the long period. When it comes to investing, you can't predict the markets. Best thing you can do is to prepare.
Just something to touch on, using global equity as a typical type of investing. If you look at 5, 10, and 15 years, global equity has actually been the top performer. However, if we look back over the last 12 months, the markets globally are actually bleeding. We have never seen it being so low. However, it's not a good time to withdraw, because what happens when you withdraw, you literally lock in your losses. So it's just a matter of weathering the storm, going through the process, trusting your structure and your strategy, and just wait it out until the market turns around.
I agree with you, Ronnie. When it comes to investing, it's about understanding how different asset classes react and what the trends are, noticing the trends. Don't react according to emotion and don't panic. Make informed decisions. These are all the things we know, but it's difficult to react like that when markets do give you the volatility that they have been giving you. This is why we recommend goal-based investing. This means you invest in a portfolio that gives you asset class exposure that align with your goals, especially in terms of risk and expected returns. So that's our recommendation at TVC Wealth and Health Managers. Thank you so much for listening. You can learn more by visiting our website and social media pages in the bio. Stay tuned for upcoming episodes of Personal Finances 101.